Okay, hello everybody. Welcome to Korean Atlanta Mentorship. Today is Friday, and I know that some of you are going to do something called Netflix and chill. We're going to do something very similar, but instead of the Netflix part, we're going to do velocity banking and chill. So, what is velocity banking? All it is a debt payoff strategy using a line of credit as your main tool. And there's really only two things that you need for it. Number one is a budget, and then number two is a line of credit as your main operating account. So in this situation, we've made the scenario quite simple compared to previous situations where people have like, 5 to 6 debts. Here we only have 3 debts. We have one credit card, one car loan, and one mortgage, and we don't make that much income, right? We're gonna make it simple. Only 3 debts. And so here, $45,000 a year essentially translates to $3,000 a month after tax. And you want to know how much house you can afford on a $45,000 a year salary? Well, if you take a look here where it says I make $45,000 a year, how much house can I afford? This is from SoFi. If you scroll down, right? If you scroll down, it says about $120,000, right? $120,000. So, and that's assuming you have no other debt, right? So, I just kind of said, hey, you know what? Let's assume we borrowed about 100,000 and we have a car and then we got a credit card. Now, if we pay these off, right, we'll be in a much better position because, right now we only have $286 and 35 cents left over every single month. And, money's going to feel really tight. And I don't know about you, but anytime like I ever went to a store and I felt like, oh my goodness, like I need some of this stuff here and money is tight, like it's not a good feeling, right? It's not a good feeling because you can't go to sleep. I remember many times when I was just completely broke. I was like, "What am I doing with my life?" And the worst part is, and I'll tell you the worst part. The people who work in those stores are probably worse off than you. Like, you ever go to a grocery store? Probably the people who work in those grocery stores can't even afford any of the products that they sell because of inflation and all that. And they're probably working, I don't know, 9, 10, 11, $12 an hour. Really sad. Really sad, right? And don't mean to laugh, but I'm just gonna make the ambience, positive environment, all that good stuff. Anyways, all right. So now we basically did the budget. Now our second goal is to make our line of credit as our main operating account. So what is a line of credit? All it is a financial tool where you could borrow money, pay back, and then use it over and over again. So the most well-known line of credit is a credit card, right? Because you pay it, you pay it, you use it, and then you could pay it again, right? Unlike a loan, whereas you borrow the money and then it's a one-time thing. If you need more money, you gotta borrow it again, right? It's a lot more inconvenient than a credit card, and the inconvenience is the reason why the interest rates are so low, right? Because they know that because like it's kind of like telling someone like, hey, we have a Netflix membership that is like very low cost, but you can only watch it from 2 a.m. to 6 a.m. because the internet traffic bandwidth is so low. But that's why it's so cheap, right? That's kind of like how a loan works. And people don't really seem to realize that. So what we're going to use is a higher percentage interest rate line of credit um, to help us pay off our debts. Now, do we want the lowest interest rates possible? Absolutely. But just realize in general, lines of credit have a higher interest rate than a loan. Okay. And we're going to assume two things. So, number one is that we have a $3,000 same income, right? We're not saying, hey, make $4,000 or make $5,000, even though that would be fantastic. We're going to say make $3,000 or make the same income, but, okay, this is one of the most important parts. We're going to do the exact opposite of Dave Ramsey, which is save money. Remember in his baby steps where he's like, step number one, regardless of what income level you're at, if you're going to build wealth, you got to save $1,000. And we're not going to do that. But we are going to have something called cash flow, which is very going to look very similar to our savings in the beginning, right? You might look at these two numbers, $286 here and then $286 here, and then you're like, wait a minute, these two numbers are the same. You're just shuffling numbers around, right? No, no, no. We're going to make this number bigger when we make, so this is step two, our line of credit as our main operating account, line of credit. And again, let's say that we're able to get, I don't know, a $10,000 line of credit. I have no idea if it's realistic to get a $10,000 line of credit at $45,000, but just be aware of this, okay? Banks don't lend money to people who need and that's why, don't be afraid that you can't make more money. I know it's kind of weird, but it's also a mindset thing because I know so many people are like, I'm just fixed at this level. But there were years where I made 20,000 a year, and then there were years I made who knows how much. In fact, I paid off my mortgage in 3 years. So, don't just try. If you're, let's say, struggling with income and you don't even have that much debt, you need to make more income. Velocity banking is for when you make more income and you borrow money. Now you need to learn how to manage your cash flow. So what we're gonna do is at least at this income level, right? We're going to pay off our debts to increase our cash flow. And let's just assume we got a $10,000 line of credit. Now, I have a $15,000 line of credit like this laying around. And I know some people are like, well, who has a line of credit like that laying around? Well, the thing is, I learned that banks don't lend money to people who need it. And so I'm able to get it because unfortunately I don't need it. And the whole goal of the banking system is kind of like big pharma, right? Like if you're big pharma, you don't want people who are way too healthy because you can't sell pills to them. And then you don't want people who are going to die tomorrow because you can't sell pills to them, right? So you got to kind of be somewhere in that middle where you're not too sick, but you're not too healthy. Same thing with like credit. Like you don't want to be like the person who pays their loans off so quickly that the bank can't make any money. But at the same time, you don't want to be a deadbeat or you don't want to be a deadbeat who pays their bills over 90 days late because then they'll never let you borrow money and give you a line of credit, right? And also your income is important because they check your income. And according to what I've heard, being self-employed is just as good as being unemployed when it comes to lending money, right? All right. So now, let's go ahead and do this. Assume we have a $10,000 line of credit, personal line of credit, and we'll say 15%. Or it could be a home equity. I don't know. We got a $100,000 home. Just be aware that because you're offering your home equity as your collateral, the interest rates go down like 9%. And then your rates, or I'm sorry, your limits go up because it's based on how much equity you have. And all equity is basically the amount that you can sell your house for minus your debts tied to the house, like a mortgage, right? So yeah, let's just assume we have. Actually, let's do this. Let's assume we have a 10% home equity line of credit because that's much easier to get because if you can offer collateral, then they have something that they can take, right? That's. But at the same time, if you only have $10,000 in equity, my understanding is it might even cost more to the bank to foreclose on if all you got is $10,000. So it's actually a risk to the bank too if you don't have that much equity. All right, so now let's go ahead and do this. So we got a credit card, car loan, and mortgage. So how do we know what the order of the debt payoff is? Well, let's use the cash flow index system, right? So basically, there's a formula called the statement balance 5000 divided by this payment formula right here 166.67, and then this one right here 24000 divided by 447.43, and then this one is 100,000 divided by 599.55. Now, just think of this as a ranking system. So the lower the number, that's the one you want to pay off first. And here's how you could kind of think of it. So the higher the number, it's considered to be quote efficient, meaning you don't pay that much payment compared to how much you owe. So would you rather pay $24,000 to get $440 back or $100,000 to get $600 back? You'd probably pay $24,000 to get the $400 back because you pay so much less um, for like much less bang or much more bang for your buck for paying it off, right? You're paying like 4 times as much and you only get like $100 more in terms of cash flow. So let's go ahead and do this. And again, you can see that credit cards are the ones we start with, lowest cash flow index, highest interest rate. So let's go ahead and move this $5,000 to this credit card, right? And then what do we do here? We get a little bit of cash flow back, not that much, but at least $166.67. So it's better than nothing, right? We went 286 to 453. Okay. And, just be aware that the maximum cash flow that we'll eventually get is about 1500, right? So I don't know if it's even possible to obtain this much debt with this much income, but Sometimes I see people with a lot of things like, whoa, even at my level, I can't afford that. And you ever watch like people at like retail stores of fast food restaurants and they somehow all have iPhones? Like, how'd you do that? Like, I can't even do that. Like, I have no idea how to do that, but that's just the way life is. As people somehow gain possession of things that they just can't afford, and I don't even know how they do it. All right, so now let's go ahead and see how long it takes us to pay off this $5,000. Now, the actual strategy itself is again income. So we'll say income into the line of credit. So put the entire 3,000 into here, and it does two things. It satisfies the minimum monthly payment, and then the interest is going to be at its lowest because it's based on an average daily balance, and then it will eventually go up based on the expenses. So the expenses are going to come out of the line of credit, right? That's why lines of credit are awesome because they're so flexible, and you want all of them. Credit cards, personal lines, home equity lines, business lines. You got a business, you want all of them. Okay, so now after every single month, it's going to go down about 4,500, not 4,000, $450, right? So let's go ahead and do this. And then now what we're going to do is take the previous month's balance minus the previous month's interest, or plus the previous month's interest minus this $453.02 of cash flow. And then what we do is we take the average. Let's go ahead and do this average button right here. Average for the average daily balance, multiply by the interest rate, divide by 12. And then you see that after 1 month, you got to pay $40 for using this line of credit. And let's just keep going, right? Let's just keep going, bub. All right. And the reason I say bub is because I recently watched Deadpool and Wolverine. I don't like this minus. I'd rather see. I probably have to reformat it because I usually like it when it's red. The text is red and negative, but I can just do this. All right. So now 12 months, and so we paid off 5K in 12 months, right? So not bad. $5,000, 12 months. Sleep at night. Now we got to figure out what the balance of this car loan is, right? So now we go to this and loan amortization. So if we got a 24 grand car at 5 years at 4.5%, okay, and let's go ahead and do this. So after 12 months or 1 year, what's the ending balance? And you can see right here, it's about 19 grand. 1 year, we paid $990 in interest already. So now it's 19 grand. Okay. Now, given that we only have a $10,000 credit line, do we need to put the whole thing in 10,000? No, we could just do small $5,000 chunks or 3,000, 4,000. I always say like just move about a little amount. Like you don't need the whole thing because what we're trying to do is prevent something called segregation of income. So even though we have a lower interest rate loan, instead of directly putting this $453 into that car loan, where we're going to freak out if we have any emergencies or anything like that, because again, when you put your entire loan into the what's it called, I'm sorry, not your entire loan, when you put your entire savings directly into the loan, people freak out because it's only a one-way street. So what we're saying is just, hey, another alternative, and again, you don't have to follow this route, to pay off the debts quickly and make it easy for you, and that's the key word, it's easy for you, is just move some of this portion of the loan to the line of credit, maybe 3, 4 grand at least for this person, and then dump your entire paycheck and then have it paid off um, really relatively quickly. Again, you got to make it easy for yourself. Easy has incredible value. It's kind of like why, and I know I've mentioned this before. UPS doesn't allow its drivers to make U-turn or not U-turns, left turns, because you ever see like in certain roads where you make a left turn and there's a huge distance between like the street from the place that you're trying to make a left turn? It's very dangerous, right? And so it's kind of the same thing when it comes to dumping all your extra cash into a loan. That's the default, but nobody does it because again, it's a scary place you want to be. And so again, once we paid off our credit cards, all right, so when we do with our loans, then we could just attack it in little pieces. And so luckily we have a velocity banking calculator for this, but just to kind of demonstrate the concept. So let's say we just move $3,000 of this car loan, so it's going to be about 16K into the line of credit, right? So let's say I move $3,000 here. Again, our cash flow is going to be relatively the same for now until we actually pay it off. And then, all right. So how long does it take us to pay this 3,000? About 1, 2, 3, 4, 5, 6, 7 months. But realize we're still making the monthly payment as well, right? But that's kind of like the whole idea of just kind of chunking and then dumping your entire paycheck into the line of credit. Now, if you're okay with just dumping your entire savings directly, that's perfectly fine. Absolutely no problem with that. I'm just saying most people will never do it because it's not easy for them, and you would have to know the exact amount of money that you're going to put into that loan. Whereas here, you could just kind of make general average assumptions, like on average, I think I'm going to pay this off. And then, so if you do that, that's much easier. And that's what I did. I don't know everything to the penny. Like my cash flow can change from month to month. You know, I have to go ahead and replace the roof. And so that's going to put me in a negative cash flow. But at the same time, in the big picture, I'm going to have a house paid off in about 2.5 years, right? So we kind of have to, be aware of those things. There's nuances and all that. But back to my point. So here we have this velocity banking calculator. Again, I didn't create this. This is provided by Renata. So if you ever want to know more information about them, just go to myrenatus.com. This is an educational company. I paid for the classes in 2017. And full disclosure, I make commission from reselling their classes as what we call an independent contracted marketer. I'm going to open up the quote sales funnel eventually once I get lazy, but you know what? I kind of don't want it because I just paid off my mortgage in the 3 years, and I'm really lazy right now, and I kind of want to flex and deserve the right to be lazy. No, I'm just kidding. Eventually, I will open it up, but for now, we're just hanging out and chilling, right? We're velocity banking and chilling. So let's go ahead and just fill in the numbers, and then we just spit out a number, right? We just spit out a number right here. So what's the original balance of that car loan? 24 grand. And then what's the current balance right here? 19621.23. 19621.23. And the interest rate, what's the interest rate? It is, what did I put it? 6.5? 4.5%. Okay. I'm going to do a lot of back and forth because I don't remember. Like, I just go on one tab. It's like, what did I see 2 seconds ago? And then I always got to go back and forth. All right. So now 4.5%, and then the payment is 447.43. All right. So now, what's my chunk amount? How much am I moving to the line of credit? Well, I'll tell you this: if you move an entire loan usually into a line of credit, you'll end up paying more just because it's a higher interest rate, right? So I'm just going to demonstrate that, and really, the most optimal amount is just doing it really kind of a small amount. I would just say do it the size of your paycheck. What really matters, the most important number is that cash flow number, right? So this is why when we're doing this, we do it in the right order. We don't want to pay off our mortgage first just to get $600 back. We're probably not ever going to pay off debt and lose money, if I recall correctly. So we want to start off with the big wins, which is pay off that 5,000 to get about 166 back. Debt order payoff is incredibly important when it comes to velocity banking, not just interest rate. Because if you pay off debt quickly, you get more cash flow, right? But if you pay it off in the wrong order, you're going to spend all this time and energy doing the $100,000 loan, only get $600 back, right? And it'll take you way too much time to get there. All right, so now let's go ahead and do this. And how much is our income? $3,000 a month, $3,000 a month. And our expenses, which is everything except for the loan we're trying to pay off. So it's 2099.55, 2099.55. Okay, so now let's just see what happens if we replace this loan, this car loan, with a line of credit, because you might have heard on the internet, all loans bad, credit lines good. I don't know about that, but you can see if we did that, we'd pay it off in about 1.9 years, but we would save absolute almost little to no interest, right? Not a 4.5 to 10, not really that great of an idea, but let's just do a small amount compared to our paycheck. And you could see that we save about $845, right? So what's better, $59 or $845? I don't know. Oh boy. All right. So again, even the car loan itself doesn't have that much interest anyways, but you can see here, after we paid off the credit card, we just paid off this about 1.9 years. So 12.1.9 year, 12 months, so it's like 2.9 years. Yeah, we'll just say 2.9 years. And then we paid off 29K, right? And you may have seen, what's it called, demonstrations where we have like more income and almost like debt up to the brim, and somehow it pays off faster because again, when you put the full power of your income in and you make more income even though you have more debt, it just pays off magically faster. Well, I don't want to say magically, obviously there's a mathematical component to it, but for whatever reason people really want to be like, what's that a TV show on HGTV about people who are like really cheap and frugal. Like don't think like that. Think about abundance. Think about, hey, even though I'm making okay money, I can always make more, right? I can always make more. I just gotta. I don't want to say hustle because I don't like that word because it always reminds me of overwork, like overwork but getting nothing in return. But just learn how to make more sales, more income, right? You can do more. You can do more. So just be aware of that. All right. So now 2.9 years and 29K. And then now we got to just attack the mortgage, right? Again, attack the mortgage in little chunks. And so what's the deal with the mortgage? Let's see. 2.9 years. How much is 2.9 years? So 2.9 times 12, that's about 35 months. So what we got to do is look at this 200 no $100,000 mortgage at 30 years at 6% at 35 months. 35 months. All right, 35 months. So 96K. 96K. Wow. Paid all those months and we only chipped away $4,000 of the mortgage. Amazing. All right. Amazing. That's why the banks have the biggest buildings in the planet. All right, so now what we got to do is we just got to just fill in the information, right? Fill in the information. So now our living expenses has decreased to 1,500, and then we put the loan amount right here. Same thing, so 100,000. And what's our current balance right now? 96,202.61. 96,202.61. 6% interest rate, 30 years, and the payment amount is 599.55. 599.55. All right, so let's take a look here. Wow, look at that. 6.5 years to pay it off. And only $20,000 of interest. Mind blown. $20,000 of interest. So 2.9 plus 6.5. So about 9.4 years. So 9.4 years to pay off everything. And that's $129,000 of debt. Now let's see what happens when we replace this entire mortgage with the line of credit. So I'm just going to go ahead and copy this. So remember these two numbers, 6.5 years and 20 grand of interest that we pay. Okay. Now let's say we replace this 6% mortgage with the line of credit. Wait a minute. This, yeah. So we did that, and you could see that it pretty much, I think, doubled. Hold on. Yeah, it doubled, right? So, okay. So 6.5 years, and this doubled. And let me do this. Yeah, now 7.7 years for 42,000. Interesting. Interesting. Okay, well, yeah, that's it for today. Again, this is just a simple velocity banking, situation because we only have three debts. It's so usually more exciting when you have like a lot more income and then a lot more debt and see how effective this strategy is. But the other thing that we also have to be aware of is that banks don't like to lend money to people who don't make that much money, right? So banks, and I know I say that a lot, but I think people really misunderstand at what stage you should apply this strategy. Or so, if you don't make that much income, as Dave Ramsey says, you got an income problem. I can't even do his accent, but you do have an income problem if even after you pay off all your debts, you're still struggling a little bit, right? So let's say we pay these off. Um, then now it's like 1,500. So if your half of your expenses are just going to debt, or not good to your general expenses, well, I mean, here's the other thing too. Nobody will rent a place to you, right? Because landlords don't like to see like the housing payment take up like 50% of your income. I think it's like you should make at probably 3 times more than the housing payment. But I don't even know how people afford to live right now, especially when I watch like TikToks and everybody's crying and struggling in the ambulance, and I'm not like making fun of them, but it's like I think as a society we've kind of lost the plot of trying to be individualistic when really the you ever notice that like all the big enterprises, even in the United States, are family-run enterprises, like Chase Bank, Rockefellers. Like, it's like okay, they'll tell you to be an individual, but we're going to do things with like combine our resources. It should tell you like why what groups are people are poor versus what groups are people are rich. Follow what the rich people are doing if you want to be rich. You know what I'm saying? All right. Well, that's it for today. So this is our Friday um, velocity banking and chill video. So hopefully you learned something today, and just keep cranking them out. And then one day I'll open up the Google form where you can come in and talk to me again, just as long as they don't get lazy. But I've earned the right to be lazy because I paid off my mortgage under 3 years. Nah, I'm just kidding, man. But let me flex a little bit. All right. Well, that's it, everybody. Have a great day, and we will speak next time.